Hello, welcome back. My name is Darson Grantham, and this is Jared. And on this episode or on this podcast, we kind of talk about the real estate market in general. We're both based out of Des Moines. I work with buyers and sellers in the more investment community in the central part of Iowa.
Mm-hmm. Yeah, Jared Huseman here, president of the Catalyst team, part of KB Commercial Realty here in Des Moines. Our team specializes in investment property, primarily 8plexes and apartments greater than 8 units across the state.
We're going to kind of dive into the meat and potatoes of the podcast in YouTube channel, and we're going to start with the market updates. So Jared, what's going on in the market? Got anything fancy you want to tell us, or
Yeah,
whatnot?
so market update. Just got back from Orlando for our convention for our Keller Williams agents and commercial agents as well. Pretty common theme was what's happening in the market right now. Gary Keller, who's one of the most respected men in real estate, was talking all about what he's seen. And essentially, what if I really want to boil it all down is we're expecting a great year for 2022. Everything's looking good. The fundamentals are okay. We've actually had one of the hottest markets in history, even hotter than 06 and 07. However, the fundamentals this time are very different. And the only thing that could derail us is some black swan event coming out potentially to the Russia-Ukraine crisis, or the Federal Reserve being too aggressive in their policies that could dampen and hurt the economy. But overall, we're expecting a very robust 2022 for real estate. And that is kind of what's on the mind with the theme I'm thinking of.
Yeah, and so that's interesting to me, just because it's every stat that we see points towards things are going well.
Yep.
Right? And when you say that, everyone jumps on that bandwagon. They want to hear good, or you want to hear really bad, right? But when you want to hear good, you have those stats out in front of you, and then you always have to caveat with but a black swan event could happen, right? And what you want to try to do is limit the possibility of your black swan events,
right?
And or have a process in place on the back end so that when a black swan event happens, you can still sustain your lifestyle, your business, and in helping people, right?
Well, so I think to that point, Darson, we come up to the point, this is something I've had a concern about before, and it's actually kind of a concern prior to COVID, and then COVID changed everything. But is the market being irrationally exuberant, or are they just being exuberant right now? And I think all investors need to think about is, right now, all the headlines, even again over this weekend I just mentioned, we're expecting exuberance. I mean, it's exuberant. So we dive into the fundamentals and say, are we being irrationally exuberant?
Yep.
And I think every investor needs to ask that question when they're looking at their investments is, am I really expecting this to be totally go with pro forma and go perfectly as planned, and it's going to just be all rainbows and unicorns and sunshine, or should I be a little bit cautious with it? And I think as long as you ask those questions of the overall market that we're in right now and of where your investment's at, I think you're going to be okay. In my experience, or at least from my limited experience of the last 13 years, not that I know what I'm doing or talking about, I feel like we're definitely in that exuberance phase. I think we're kind of getting on that, maybe the tail end or the beginning, not tail end, but maybe the beginning part of irrational exuberance. But I think there's enough cautiousness and the optimism in the market. I still have a couple investors saying I'm waiting for that negative downturn, that depression. And whenever you have a few holdouts, that generally means the market, in my opinion, still has some room to run.
Yep.
It's when everybody is saying this is the best time ever and jump in when you have that just, okay, this is irrational.
Yep. And it's so hard to know. So it's like timing stock market, right?
Right.
You're never going to time the stock market consistently forever.
Right.
Because you have to time it too many times. So it's the same situation where do your sound investment processes, philosophies, whatever, have your reserves account, and then go wild.
So on that point, I think Gary Keller did in his vision speech yesterday, very interesting. And one point he made that was really key was he said, look, if you look at the historical market, if you plan to stay in your home for more than 10 years, you're fine.
Yeah.
Whatever happens, you might have a negative downturn for a couple of years, but 10 years, you're fine. And the reason I thought that was really interesting is I think it applies to investors too. If you take your time horizon from that 3 to 5 years and you really boil it out to, I want to have some investment property for 10 years, And I'm going to be, again, irrationally exuberant here. I'm going to be cautious here. If you say, I'm going to own this investment property, whatever it may look like, apartments or houses, as rent, as income for income purposes, not a flip, not a wholesale. I want to have it for 10 years. I am not going to live off the cash flow. That's key.
Yep.
I'm going to just keep the cash flow in the property or paying it off. And I want to own for a minimum of 10 years. I think you're fine. I think you're good. If you try to time that market, that's another story.
Yep.
But I think if we always come back to the time horizon, the longevity, and again, build your reserves up, don't live off the cash flow, I think you can still buy today, right now, and make plenty of money, as long as you're not doing crazy things like interest-only payments forever, as long as you're not just basing your principal off, selling it in 2 more years for higher profit.
Right. I try to go back to like what happened in 08 and 9 and like who are the people that really failed at that time? The flippers that were planning on appreciation, the developers that were planning on the lot that they bought for $10,000 was going to be worth $30 by the time they closed.
Right.
Like literally a lot getting sold 3 times. Like that's crazy. But I haven't never met anyone who lost money in that world when they bought cash flowing properties.
Right.
So if you kind of tie that back to, yes, not all investments will do well if you just plan to hold for 10 years.
Right.
Like, because you could buy a lot that never gets developed.
Right.
In 10 years, and like it never cash flowed, and it's never going to, at least not in 10 years. But if that property is coming close to cash flowing, in 10 years, I think you're set.
Well, and one thing I think we should talk about a lot, this ties really directly into our market with our investors, is the market fundamentals have changed. And by that, what I'm saying specifically is millennials. Millennials are the #1 buyers right now of homes, just general speaking.
Probably of renters,
homes.
renting too.
And of renting. Well, that's the thing I was going to say, is that millennials are the biggest demographic population since the baby boomers in the 60s and 70s. The last major apartment boom we saw was 60s and 70s. And that's why we've seen so many apartments get built in the last 10 years. These apartments were being built to service the millennials. The problem is the millennials now are aging into home ownership level. And this is why COVID just exacerbated what was already happening. But the average 30-year-old was starting to actually move into the house anyway, before COVID. COVID just made it faster. So this all ties back, though, as well, is that some of these people, millennials, are choosing to rent, not to own, as well. And that big population is what still needs housing. It needs housing. It can't just be in a college dorm. It can't just be at their parents' basement. And this is why I say this, is because if you look at the fundamentals of 6 and 7, there were homes being bought that were never lived in. They were just being bought purely on speculative basis. And right now, all the homes that are being bought are either being lived in or are being rented out. We still have a massive housing shortage in our country to house all the millennials that are pushing through that demographic. And I think that's why I see housing as a great space to be, whether you're looking as a home ownership level or an investment level as well, because we are still short of that, and our development cannot keep pace with that demand.
I was having a conversation with another agent in the conference room. It was this morning, and he goes, "What do you think? What do you think the market's going to do?" I'm like, "I don't know. I think in the next year it's going to be good. In the next 10 years it's going to be good. In the next 5 years I don't know." Right? Which is a cop out, but it's just what I'm seeing. But I told him, in my opinion, and I don't know where to track this because I haven't dug down into the research, but it was a guy that he does a little bit more new development stuff, and I said, "Hey, if a house is built under $350,000 right now, how long does it sit on the market?" And his answer is, it doesn't. It's literally it will not sit on the market. Right. I said, I want to know who can track that number to say when that house that gets built now sits in the market one day, I want a red flag. Right? Because that's going to tell you that things have changed.
That'd be a leading indicator, essentially.
It would be a leading indicator. I don't know the answer of how to figure that out. That'd be a really good way to like just set your mind at ease, right? Of just like, stop thinking, stop having to like watch all of the data and pay attention to everything. Like that would be, I can't find out why that wouldn't be the indicator on the entry-level market.
Right. Well, and I think we need to talk about, too, for anybody getting into real estate right now, again, let's go back to this irrational exuberance and back what we're seeing the theme of the market right now. When COVID hit, we saw an irrational exuberance towards the tech stocks, towards the Pelotons, the Zooms, towards the Tesla. And we've seen that in the market in the last few months has punished that irrational exuberance hard with 20, 30% drops, 50% drops. So we saw that and we're seeing the repercussions of it. Have we seen the irrational exuberance in real estate? I would argue no. And at the same point too, the reason I bring this up for a reason is that recessions don't hit all sectors equally. I mean, we can look at from the 2000s, the 2001 was at the end of the day a stock market drop, but real estate did fine. 08, if you actually track 08, personal opinion only, it wasn't necessarily a real estate downturn, it was a credit downturn. Credit stopped. All the banks quit lending. That's why you saw the influx of capital from the government during COVID. They realized that they put money in people's hands, they will spend it. So that's leading to this massive inflation we're seeing as well, and all the different supply chain issues as well. But we could have another recession in a couple of years, another year or two. I don't know. I don't have the answer for that. I don't try to predict what happens or black swan events.
Or if a recession even hurts.
But will it affect real estate is the question, and I don't have the answer for that. We could have a massive recession without affecting real estate. Now, a depression will affect everybody. So, like you said, I don't really know, but it's always interesting, I think. Long term, I think we can say we're going to be okay. I mean, short term, we don't know. It's easy to look out 1 year and say, I think we're going to look good. 10 year, think we're going to look good. 1 to 3 years, 1 to 5 years, I don't know.
Yep. Which is why, I mean, that's why we pay attention to this regularly and watch it, and we talk about this weekly, so over time, things might change, you might have different sentiments, but all in all, I mean. At
the end of the day, I mean, what we're really watching right now, we're coming into the first part of March for anybody out in the market. The Federal Reserve came out and said they were going to raise rates potentially half a point coming into March. I just saw this morning in the paper, they're already discussing now only a quarter-point raise. They're already pulling back on that here. So understand that the Federal Reserve's trying to cool things off a little bit. And they're kind of, in my opinion, whether it's Putin or it's Federal Reserve, I think they're both posturing, trying to push things up to slow things down and get what they want. And they're going to always keep pulling back. So this is why I expect still a strong year. The next couple of weeks, keep an eye on what Fed policy is, whether it's a quarter point or half a point. If it's a half a point, it might slow us down a little faster. I think a quarter point, we're going to just take it as a speed bump and keep moving forward. My personal opinion.
Point of topic this week is cap rate. The reason I brought this topic up, and I said, hey, Jared, let's talk about cap rate. And he said, well, you know, it's pretty generic. It's pretty, you know, what are we going to talk about? And I was like, let's talk about how it matters a lot and it matters a little, all in the same breath, right? So those of you who are newer, we're going to talk about cap rate is kind of like a 101. And as we get going, we'll get more into the advanced, like, cap rate discussion.
Okay.
Is that fair?
Let's do it.
So cap rate, capitalization rate. And I'll let you, how about you? You want to dig into, like, what is cap rate?
So I'm gonna make a really basic example. I use it all the time. A capitalization rate, a cap rate. At the end of the day, it is if you were to own the property 100% in cash, no financing in place, it will be your return on investment. So I use this example a lot. I use it all the time. If you were to go out, we all did this one time, and create a lemonade stand. And you say, I'm going to have a lemonade stand, I'm going to spend $100 to open it and run the lemonade stand for a full year. And after 1 full year of lemonade stand and sales, you have $10 that you made, you have a 10% cap rate. That is capitalization rate 101.
So it's a return.
It's a return. You spent $100 to buy something, and at the end of the day, you always do capitalization rate based on 1 full year. I don't know why, who chose it 12 months or a year. That's a very interesting debate we could have or do some research on. Feel free, if anybody knows, comment, like, and share. I'd love to hear if anybody knows why we chose a year. But at the end of the day, you take a 12-month return, and that is your capitalization rate.
So you can find cap rate if you have your net operating income, the money you made, less expenses, right, divided by your market value. So if you have both those, you can find the cap rate. So just on the verse of that is if you have a industry cap rate, and you have the market rent or NOI, the income that is produced, net operating income, you can find what the market value of the property is. So a lot of people trying to calculate a cap rate when in reality, like, you need to know these other couple things to get the cap rate or vice versa.
So it's at the end of the day, it's a formula. It's a formula. It's an algebra formula. I'm going to go back to the lemonade stand. To your point, if we take the $10 example, you made $10 net operating income. That's your net profits for a year. Well, let's just keep it very basic. $10 is your net profit. and your $100 was into it. 10 divided by 100 is a 10% cap rate.
Yep.
Now you can reverse that. What if you say, I know I made $10, and I know I want to buy at a 10 cap. Now you take 100 times 10 and you create $100.
And the reason you would know you want to buy at a 10 cap is because you want to make a 10% return.
Return on your investment, yeah. So again, if you have 2 of the 3 variables, net operating income, the initial investment, or a full investment, I should say, and then your return on investment, your cap rate, those 3, if you have 2 of those 3, you can work the math any way you want. Divide, subtract, divide, multiply, whatever it may be to create that. Now, here's where it gets interesting, is that everybody has different rates of return. You might want a 10 cap, I might want an 8 cap. You might want 12, I might want 15. And that's where numbers get really interesting. So the cap rate is just what's an investor's desired return on their investment. What gets really, really interesting now, this is where we get in, this is where we have jobs, I think, is being able to understand. I'm going to use Lemonade example.
Are you getting into financing?
No, not that. No, so if I own a lemonade stand, this is where people need to understand how to understand value. If I own a lemonade stand and I spend $100 to open the lemonade stand and I create $10 return, and that's a 10 cap, but you, Darson, look at this lemonade stand and say, Jared spent $100 to buy all the limes, all the sugar, and all the water. I can go straight to the distributor and get those limes and that sugar and that water for $90 and still create the $10 revenue of return. Now 10 divided by 90 creates a 12% capitalization rate, whatever it may be, or whatever that number looks like. It gets better. So this is where it's really interesting. As investors, you might be able to do the opposite. Maybe you say, you know what, Jared's only charging $1 per lemonade. I can charge $1.25 and make $12.50 on that same $100. So this is where it gets really interesting. This is where you need, as an investor, learn of where can I decrease my expenses and where can I increase my income to ultimately change that return on investment. And that is where an experienced investor who knows their numbers will be able to see that. And that's where experience is. The beginning, it's easy. You just look at the numbers. But as you get more experience, you start diving into, that's wrong, that's right, we can do better here, let's be more efficient there. That's
absolutely right. So you can change, on the equation, you can change 2 formulas. Or 2 sides, two numbers to get a better return on investment, a better cap rate.
It's just that simple. I mean, at the end of the day, and where we as agents help, whether it's in duplexes or investment houses, apartments, and our experience level is we're able to evaluate how much does that sugar cost and how much do those lemons cost, and be able to say that's accurate or that's too expensive, or in the performer world, that's bullshit. That's complete bullshit. There's no way you're going to get a lime for a penny when everybody else is charging 25 cents.
And so that's one of the things about cap rates is when they are marketed to the general public, usually what you're seeing is pro forma. Right. You're not seeing the actuals. You're seeing the pro formas.
In today's market.
Most typically in today's market. So that's been different in different markets?
So in past markets, in the recession, you would see a lot more actuals because it was just the market, and it was okay because...
Were they better than the pro forma?
Sometimes, but the same point, it wasn't... Again, pro formas only happen when sellers it's a seller's market and they want the most price. But in 2011 and 12, the seller said, this property sucks, basically, and we know that. We're going to sell it at 10 cap. We'll show you our numbers, and you can do whatever you want. I mean, we still saw pro formas out there, but it was more common to see the actuals just because it was a buyer's market. So as you shift from seller's market to buyer's market, you'll see pro forma pull back usually, and real numbers come more to light, typically. In my experience, now I could be wrong, but that's what I've seen.
We'll see.
So,
or maybe not. Who knows?
Yeah, maybe we're wrong.
So one thing that a lot of people get caught up on is the cap rate and what they're seeing in the pro forma. Right. It's one thing that if you are going straight to a listing agent when you're talking about a commercial property, and you ask them, about the cap rate, they're going to tell you pro forma every time. And so that I honestly think that's one of the best things, one of the main reasons in the commercial multifamily world that you should have a buyer's agent and not go direct. And direct to the listing agent.
Right.
Because you need an agent that will run these numbers with you.
Right.
I've talked to other agents and that are maybe primarily do residential, right? And they're nervous about running numbers with someone because they're going to give them bad advice. And I totally caught me off guard because I just didn't think about that being a risk, which it maybe is a little bit of a risk. But if your agent is not running the numbers with you to figure out what the actual cap rate is versus what they're selling, the listing agent is selling you on, like that's an issue. And so you need to do it to try to figure out what your numbers are.
Yep.
Your agent should do it alongside you or without you, and then you guys share and figure out, hey, what do these lemons cost you?
Right.
Because I think they cost this. And between you two, you can consult and figure out what a good offer.
Well, I mean, at the end of the day, it's just the law of averages. There's actually a statistical mathematical model called the law of averages, that the more people you get to make guesses, the more accurate you're going to get. It's just how it is. So if you have one seller, one agent, one buyer, you got 3 eyes on it. You get a buyer's agent, you'll have to get 4 eyes on it. Your odds of getting more accurate information is going to get better if you have more eyes on it. It's just how things work. It's just basic math.
Okay.
This is also why it's important, though, too, I'm going to caveat this as well, is that make sure whether you're working with a seller's agent or a buyer's agent, either one, they are experienced in this.
Yeah.
Because, I'm just going to be very blunt here, I've seen a lot of residential agents who say they know cap rates, and I start going into the details about arbitrage and leverage, and what about tax rates jumping if the property tax is reassessed? What about insurance going up? What if you could decrease utilities? What are the rents maximized? And their eyes glaze over.
Yeah.
And they say they know cap rates, and maybe they do.
They know how to calculate them.
They know how to calculate them. They know how to look at them at one specific standard point. The other problem I have with cap rates, I'm going to dive into why cap rate also sucks.
Okay. Yeah.
Because let's get into this now.
Yeah.
Let's go on to why cap rates are terrible.
Yep.
Beyond just the fact that you can use pro forma and start underwriting what lemons and sugar cost.
Yep.
Is let's use the lemonade stand, for example. Let's say you have a lemonade stand and it's on a very, very busy street. And you get that same $10 a year of return on a $100 investment. All of a sudden that street goes under construction and now you have no traffic on that street for a full year. And all of a sudden you have nobody stopping to get your lemonade, and all of a sudden that profit goes away. A cap rate is a picture in time of what has happened in the last 12 months. So to say I want to buy at a certain cap is like looking at a picture of a relative of yours, a friend or a child, and saying that's exactly what it looks like another year from now.
Yeah.
Anybody knows, if you look at any picture in time, it's a picture, it's not a video. If you take a picture of a child growing over a year every day, that year's gonna look way different. Yep. So this is also why cap rates suck, and it's also why sometimes performers actually are better, because sometimes that actual cap rate, maybe the owner was terrible at doing it. Yep. And maybe that new owner can come in and do it better. So a cap rate is a picture in time of what's happened the last 12 months.
Yes. A
performer is what it can get to.
Yes.
And at the end of the day, you need to take both and you're also experienced to merge them together to create a video of the property, and that's kind of a metaphor,
yep,
than just a picture.
Yep. So again, it kind of goes back to your explanation of like, you need a lot of different data points to figure out the truth.
Right.
A lot of different opinions to figure out the right estimate.
Right.
Same thing. Because I would agree, like you should run your own pro forma. Maybe that's where I said I laugh at pro forma. Run your own pro forma.
Right.
Don't just rely on the listing agent's pro forma. And like I don't say that because we want more buyer agent or buyer clients. Like I just have seen a lot of people been given the advice, go to the listing agent directly. You have a better chance to get the deal because they'll want to get double side of the commission, which is true. But you know what that means? They're not representing you all the time with your best interest. So that, from the consulting side, the transparency side, that's where I brought up that.
Right, and that's where I come back to. You might a lot of times the consensus is amongst buyers, I'm gonna go straight to listing agent so I can save 1 or 2 points on the sale price. You know, and that's a lot of money. I mean, on $1 million or a couple $1 million property, that can be $20,000, $40,000 instant equity in your pocket. But if you don't run your numbers right and you miss something, it can also cost you a lot of money very quickly as well. So again, like you said, just have advice, and the more experienced you are, the better you're going to be. So if you're experienced and you say, I can do this, I have experience underwriting, maybe you don't need the agent. That's okay. It's nothing wrong to say that. Is it going to hurt to have another pair of eyes on it? Maybe, maybe not. I don't know. It all depends on your comfort level of that. But I think the key we have is that everybody says they know cap rates. It's a very simple term, but it's kind of like that book, 50 Shades of Grey. I mean, it gets very gray very quickly all of a sudden if you start getting into how much do lemons cost, how much does sugar cost, what if the road closes down, what if you can increase the cost of your lemonade from $1 to $1.25. This is where it gets really convoluted very quickly. And again, it's only a snapshot of the last 12 months. I want to keep reiterating that. It's 12 months. One thing happens, a black swan event comes out like a pandemic, and all of a sudden you can't collect rents for 18 months from a multifamily apartment complex, or you can't evict them. All those numbers go absolutely out the window within a day.
Yes. So I always look at cap rate too. All of that is true, and it's the same way with almost every asset class.
Right.
Right. So stocks, same way. So one of the ways I understood cap rate is like, I didn't really understand stocks. I still don't fully understand them, but it's the same thing as like, I believe it's like a PE ratio. It's another data point, right? And it could look like great in the last 12 months, but one thing goes wrong. Your CEO goes and smokes weed and everyone hates on it, right? Like it crashes. Is that your fault because you own that? No, it's not, but you didn't do your research on that CEO, right? So like that's how I would consider cap rate, is like it's a return data point. It's what you can expect. And one of the things, unless you have something to add there.
I do actually, but keep going.
No, go ahead.
So the one thing I was going to say on this is where the difference between, this is why I love real estate more than stocks personally, is it comes down to the efficient market terminology. If you believe in efficient markets or not. If you don't, go ahead and read about it. But efficient market essentially says what I said earlier. The more people you have looking at a solution or a problem, the more likely you're going to have the right solution to that problem. It's efficient market theory. It's been around since the 80s. It came out of the University of Chicago. The basic premise of the stock market is it's efficient because everybody has actually already looked at those numbers and everybody's trying to now analyze it the same way to come up with answers. Now, we know markets can still be inefficient. 08, 09 was crucial for that. COVID was as well. It threw things off. So we know markets are inefficient just by its very nature. It's still people analyzing numbers, and people are not efficient. Numbers might be, people are not. I tie this back for a reason. The reason that real estate and cap rates are so interesting is because you generally have less people playing in the real estate market than you do stock market. And because the numbers are not all out there broadcast to the public in the form of quarterly reports, annual reports, profit and income, stock prices, etc., it becomes more inefficient, which creates a greater ability to create income, create wealth, create leverage, and ultimately find an inefficiency in the market. But you have to be able to understand the inefficiencies of those limes are too expensive, that sugar's too costly, I can raise my rates. And that's why I love real estate, is because you can find inefficiencies generally greater.
So you think inefficiency, or you're saying that efficiency market theory is because there's not as much transparency and there is fewer people looking.
Correct.
So I would probably, I agree with that. I would just say it's the first one. It's just not transparent, right? If you think about that, like there's just as many people that want to invest in real estate as there are that want to invest in stock, right? In the asset class, probably. But because stocks are so transparent and it's just, it's all digital, and real estate has not caught up there. It's close, it's getting closer. Zillow, Redfin, like they're getting closer.
This is actually what I want to say,
it's getting closer. But those of us that are trying to invest in real estate, we're like, everyone is looking at real estate.
Well, so this is very interesting. This ties, we didn't plan to go this way, but I'm going to dive into it here because I think this is really interesting for anybody who wants to know how we think or how I think, which is kind of weird. But what you just said is actually very accurate, is that one, it's why we do our podcast, is we're trying to create transparency because there is so much opaqueness. There's so many agents out there who are lying on pro formas, who are doing a bad job, and we see that in our own market in Iowa here quite often, any market really you're in, and we want to create transparency around our market for our investors. But what you just said, I think, is really crucial as well. This is why I talk to my clients a lot. I've got a few clients that are older, and they always talk about the good old days. Well, back in my day when I bought 90s, I could buy at 10 cap, 12 cap deals all day long, 14 caps, whatever the heck it was.
Yeah.
Well, understand the market was even more inefficient back then because there wasn't online, there wasn't Zillow, there wasn't Redfin, there wasn't Appfolio to manage your portfolios, there wasn't management companies. The market was more inefficient. The more efficient the market is, the more you're going to see investors say, I don't need as great return because I can create efficiencies in the market. So one reason to explain, beyond just interest rates going down, the cap rate compression we've seen and cap rates going down over the last 30 years is the market efficiencies in real estate. And this is something I think we're going to continue to see. People don't want to talk about it. But with the growth of CoStar, Zillow, and the blockchain, honestly, the blockchain and the ability to track information and verify it is going to drastically change how real estate's valued. And mark my words, this is going to be, I'm going to eat these words probably, but in 20 or 30 years, you will see real estate be almost as efficient as stocks.
Yeah, I would agree. I mean, I don't know if it'll be 20 and 30 years. It might be more.
It might be 10.
I don't think it's going to be 10.
Yeah, 10 would be a little fast.
10 would be super fast. But yes, it has like.
I have a theory that technologies take 30 years to change the world. It's my personal theory. The internet came out in the 80s. We really saw the birth of the internet in the mid-2000s, or mid-2015, 15, 14, 13, 12. It wasn't even 08, 09. Understand what COVID happened. If that COVID had happened in 2008, 9, it would have drastically put the economy in a depression. We did not have technology available.
It killed us.
So the internet came out in the early 80s. We really have seen the mass adoption of it with the birth of smartphones, which was in the basically 2011-12 range.
Yeah.
So we saw it took about 30 years for the internet to change the world. I think blockchain will do the same for real estate. I think in 30 years, you'll see real estate become very efficient.
Yeah. I mean, I can't, at some point, everything is going to more efficient scale. Like that's just.
And I think also this ties up into this is looking for the future here, but this ties into fractional ownership. I think fractional ownership of stocks, we're seeing it right now with the birth of Robinhood, but fractional ownership, the diversification of wealth, and the more efficient the market is going to be a huge trend for real estate going forward. And this all ties back into cap rates again because it becomes that cap rate's going to keep going down, because you have more and more people investing in that saying, I'm okay with 5%, I'm okay with 4%, I'm okay with 3%. And you're mitigating that risk from 1 person to 10. Mm-hmm. And now you have not just one person look at those numbers, you have 10 because you're all combining your funds to buy that. That's going to be a huge trend, I think, over the next 30 years.
Yeah, and we've even seen that in the syndication world.
Absolutely.
On a less than transparent way, right? I mean, it's just that's how syndications are. Like, they're just not transparent from what I can tell.
Some are, and so this is the thing that we're going to have the haves and the have-nots.
Yeah,
and the cream will always rise to the tops. And the good syndicators, the good REITs, the good investors, the good performers are always going to rise to the top. The bad ones always fall to the bottom. At the end of the day, the market is very efficient, and it's also lethal in that sense. So
I love it. I'm a free market guy. So
absolutely.
I'm a big fan of it.
It'll crush you. But again, the reason this is important is this all ties back into cap rates. Yeah. And again, cap rates this is going to deep dive now. We went from the lemonade stand, the basic level, to this is where we're going. This is what's going to happen. This is why cap rates, I think, will stay low. Cap rates, we can go another time, are based also a little bit on your debt levels, what you can afford to borrow and not. But I also will argue that I think interest rates are going to stay low. First of all, fact, like we just talked about, I mean, if a bank's going to lend to one person, that's a lot of risk. But if I'm lending to 10 people, that risk becomes less.
Right.
Because now I'm mitigating that risk. So again, I can afford to do a better interest rate on that debt because I've had 10 people that are signing on it.
Yep.
So I just think that cap rates are low, and anybody who says I'm waiting for that time to buy at the 10 and 12 cap is looking at the past.
If you looked at cap rates and you compared them to stocks, besides PE ratio, there's a lot of stocks that have a 0 or negative cap rate, right?
Absolutely. I mean, Tesla.
Yeah,
Tesla,
so
Amazon.
all of your startup, all of your nonprofit would have 0 or negative cap rates.
Right.
Are you seeing any real estate bought with a negative cap rate?
Yes, sometimes.
Okay.
So it depends. But At the end of the day, this is a weird thing. I make a lot of analogies from real estate to stocks.
Yeah.
And at the end of the day,
clearly.
stocks, you are either, generally speaking, one of two types of investor. You're a growth investor or a value investor. Growth is buying Google, hoping for it to get better. Value is trying to buy Google when it's on sale.
Yep.
What we've seen change in our market is it's gotten harder and harder to become value. So we're seeing more and more growth in our real estate. Same way, people are buying for the growth. This explains why people are coming into our market in Des Moines, and we're seeing prices never seen before. And most of our buyers and sellers are going, this is crazy. But the buyers are buying for growth. They're not buying for value, they're buying for growth. They see where Des Moines is going, they're seeing numbers, and we're seeing it. We talked about population growth. I think we mentioned it last week.
Yep.
And it makes sense from their perspective. They're buying the growth of Des Moines. And
they're barely buying the asset.
Right.
Like literally the asset, it has something to do
and
with
again,
it, but it's not.
Let's go back to, again, real estate. So why would you buy Tesla when it's almost never made a profit? Because you're buying the trajectory that Tesla's going to totally change the world in 100 years. Well, people will buy sometimes a negative property cap rate. I've seen properties trade at 2 and 3 caps with their debts at 4 and 5s, but you're buying the growth of it.
Yep.
So it happens in real estate too. Stocks and real estate are very transmissible because they're still investments.
Yep. If there's anyone that wants anything more specific on cap rate, because what we didn't dig into is the financing, how financing fits into a property.
Yeah.
And we'll do another podcast or YouTube video on that because we kind of have some more, what do you call it?
Arbitrage.
Arbitrage, right? Interest rate arbitrage. We'll do an episode on that, which has a lot to do with your cap rate and your financing and how all that meshes together. So instead of making this episode 2 hours long, we'll just stick with this and we will take it out now. So if you want to reach out to any of us or either of us, I'll let Jared go. Like, where can we reach out to you? Aside from the show notes. So again, in the show notes, there's complete information on both Jared and myself, how you get a hold of us, where you can gather more of our content, what we're putting out in the world. But here you go.
Yeah,
Jared.
at the end of the day, Jared Huseman, you can just Google me, Jared Huseman, JaredHusmann. I pop up on all the first couple pages. It's all me. Otherwise, our team is the Catalyst team, KATALYST.com.
Cool. And where you can reach out to me is any of the social media platforms. Darson Grantham, you'll find me, whether it's TikTok, whether it's Instagram, Facebook. I usually don't create 2 different accounts, whether it's personal and business. It's all just one account. Also, I send out an email every Friday. It's called my Take It or Leave It. And sometimes it has to do with real estate. Most of the time, it just has to do with my general thoughts on the economy, on management, on philosophies in general. I enjoy writing that quite a bit. So that's an email newsletter. It goes out weekly. Or the Darson Grantham YouTube show, right? So just talking about wealth creation, management, real estate, all of that is on the Darson Grantham YouTube show. So those are a couple places. And until next time, we'll see you later.